Hi everyone, it's Ari here. Welcome to Lecture 4. In this lecture of the Insider Trading series, we're going to talk about how aggregate insider trading information can be useful for timing the overall stock market. It helps when you make an investment to also have the market move in the same direction as your position, because we know that a lot of the variation in stock prices is due to covariance or correlation with the aggregate stock market. And there's some evidence that when you look at aggregate insider trading activity, you actually can forecast longer term moves in the overall market. So you can see whether the market will be on your side when you make your long position or short position. To do this, let's look at some of the data, and I'll walk you through how the data looks and show you some examples of when it's useful. So OpenInsider.com, which I've referred to a couple times in this course series, has a section called Charts. And if you click that section, it'll take you to a chart series that shows you in red, it shows you the number of sales, and in blue, it shows you the number of purchases. And you can change the time window over here from and to, and see how it varies. And right away, you can see that there are times when insider selling, for example, is much higher than buying. And you can see vice versa. There are times when insider selling is actually lower than insider buying. So what this is doing, the way that what I mean by aggregate is it's looking at the number of purchases in this case and the number of sales. So here, for example, for the week, I think this is a week, no, for the day. So for the day of August 24th, 2015, you have 239 insiders make a purchase, and you have 108 insiders who make a sale. And so for this chart, they're literally summing up how many buys and sells. They're not looking at the number of dollars that were bought or the number of dollars that were sold, which is another type of chart. And the nice thing about looking at the number of transactions rather than the number of dollars is that the number of dollars can be very skewed, meaning you could have one day a CEO who's a billionaire buy $200 million, $300 million of stock. And it's really just one person who made a big purchase that day. Everyone else made maybe very small purchases. And because of that one big purchase in the mix, you get a very skewed mean or very skewed number, sense of the size, right? So it's somewhat more resilient to these outliers if you use the count rather than use the dollar value. So here you can see how the selling and buying activity are varying, and this site gives it to you in almost real time. They give it to you maybe with a 1-day lag, it looks like. Yeah, so 1-day lag. So it's Sunday and we don't have Friday data yet. So this is a pretty real time indicator here that you can use, and you can use it for longer time windows. So let's look at a certain time window. I changed the dates now to January 2007 to December of 2009. So I wanted to encapsulate the financial crisis. And you can see here, in May and January, there was actually quite a lot of selling versus the amount of buying. And you can see that it started to track each other, but then you see a real disconnect here in November, late November, and then again in March. And these are the times when the market is really crashing. So what you can see here is that when the market crashes, usually we hear that stockholders make mistakes. They sell their shares right when the expected return is maybe the highest, and because they get scared and fearful. So there's a quote saying that when other people are fearful, you should be greedy, and when other people are greedy, you should be fearful. What people don't usually say is who's on the other side. Who are the greedy ones when everyone is fearful? And it's the management, or it's the people who are generally wealthier and less and more able to survive the downturn. So what you see here is that the CEOs are part of the group that are buying up the shares from all the individuals who are selling. But you can see that they thought during this time when everyone was very scared, the CEOs and executives thought that the stock market was very cheap. So you see a drop in insider selling. Look how low the insider selling is, right? It's one of the lowest regions of the whole chart, right? And then the insider buying is at the highest. So you can use, especially during times of crisis, you can use the amount of insider buying as a way to see how comfortable the CEOs are with the situation, and use it to perhaps time when you choose to enter or re-enter the stock market. And then back here, you guys say, okay, there's a very big disconnect between insider selling and insider buying, so maybe it's a time to reduce my equity stake. So these are the kind of decisions that you can make by monitoring the aggregate number of buying and selling on the part of insiders. Now, it's a little hard here to interpret relatively how much buying and selling there is. So, and there's a lot of movement here, up and down. You can see on a regular basis there seems to be this volatility up and down, up and down, up and down. And part of that reason is you can see there's some data showing that the average monthly insider buying from 2006 to 2012. And you can see that there's some seasonality here, and they explain that this figure explains that the seasonal patterns of insider trading are partially a result of the blackout periods around earnings announcements. So you can see that when companies announce first quarter earnings in April, or earnings in July, or earnings in October, you generally have lower numbers of buyers. And a lot of this, it has to do with the fact that around earnings season, 2 weeks or 3 or 4 weeks before earnings are released, insiders are not allowed to make any purchases. And the policy there is to prevent insiders from accidentally or from reducing their incentive to take advantage of information that's private about earnings that hasn't yet been released, and also to reduce the potential liability for the company by showing that they have safeguards in place to prevent insider trading. So they have seasonality in part due to, so we can see October, July, and April are generally low, and we can see here, let's see, here's October. This is the crisis, so let's look at October before. Here you can see October was pretty low, and then you can see January was pretty low. So the number of purchases is going up and down in large part due just to this blackout period around earnings announcements. So how do we interpret the volatility then in ups and downs? Well, I was talking mostly about disconnects. So when you see a large gap between buying and selling, and an easier way to perhaps capture that is to look at what's called the buy-sell ratio. So here you keep track of the number of insiders buying divided by the number of insiders selling. And that ratio is more immune to these blackout periods. It sort of cancels out the seasonality, right? Because you have seasonality in the numerator and in the denominator here. So when you divide, you cancel out the seasonality. So you can see here, for example, this is provided by secform4.com. You can see that this is from 2014, beginning of 2014 to end of 2015. And you can see, for example, here when the stock market went down, the stock market's the red line, it's the NASDAQ. It went down from March to May, say, and during that period, actually, the ratio of buying to selling spiked. And then you can see that shortly thereafter, the stock market increased quite dramatically. And as it increased, the amount of buying to sell ratios dropped, which means insiders were selling into this increase. And then they started buying again, right before this increase, and so they must have realized that there's going to be another positive shock up ahead. So the advantage again of following insiders is generally they're closer to the front line, so they're more aware of the shocks that are happening in the economy. So they're more aware of how certain policy is impacting their customers or impacting their order flow before they even report it uh, before other people become aware of it. So you can see here they thought there might be a negative event happening in the future, and then you can see the stock market overall falls quite significantly. During the fall, the insiders were buying and they bought. So you can see that they don't always time the market very well. So as the market fell, they started buying more, but they bought it in a little early. It kept falling some more, and so it spiked again. They bought some more here, and then you can see an incredible return. And as it jumped, you can see that the buying rate stopped or slowed down. So another way to say this is that insider buying in aggregate tends to be counter-cyclical. So when the market goes down, the ratio goes up. That's what it means by counter-cyclical. And which is interesting because that's what you're supposed to do as an investor. You're supposed to buy low, sell high. And it seems like the CEOs and insiders are pretty good at doing that in aggregate, whereas the average investor is less able to. And I think part of the reason there is that the average investor is so removed from the front line that they get scared because they don't have great information. And so when they see the stock price fall, they don't know whether that's whether that's a correct move or whether that's an incorrect move. And the CEO with better information is better able to evaluate whether the market is oversold or overbought. And you can see here during this fall off, you can see also again a huge spike in buying to selling, and again buying to selling. So counter-cyclical, and then you see quite nice recovery. So I think that this aggregate buy to sell ratio is extremely useful. There are very few websites that provide this data. This data is 6 months delayed. I wrote to the web developer for Open Insider and requested that they also include a buy to sell ratio here because it's very, very useful. You can construct it because they give you all the data here, so you can go by hand and construct it if you wanted to. But it is I think the more intuitive ratio to look at because it gets rid of the seasonality that we saw because of earnings seasons. Okay guys, that's the lecture on how aggregate insider information can be useful for timing the market. Have a good one. Bye.